Welcome to the Professor Lending Institute, where we make sense of housing economics and the home buying process. I'm Jordan Steffaniak, president of Professor Lending, licensed loan originator, and your home buying professor. And in today's episode, I'm going to be covering the topic of whether you should trust a mortgage lender more or less than a bank. So oftentimes what happens when I talk to potential customers is that there's this general unease when it comes to mortgage lenders or mortgage brokers. Now, this isn't universally the case. A lot of people don't have this distrust because they're properly educated on the differences between these types of lending institutions, but there's still this just general aura in the era that makes you think that, hey, these people aren't trustworthy. So I like to think of it as this particular screen right here that you'll see. You have this idea of what society thinks you do. In The Big Short, you're just laying on the ground doing whatever as a mortgage lender. But then here's what I like to think of myself, what my mom thinks I do, what I think I do, and then what I really do. Both of these are Sherlock Holmes adaptations, but here I am fighting off the mean banker, underwriter, bank guy to protect the family and give them a house. So what's the truth here? What's the truth of the matter? Why is there sometimes this assumption that banks are somehow more trustworthy? Well, if you know our history, American history in particular, banking history, read a great book called Private Finance and Public Power. And what are the names of the authors? Peter Conti Brown and Sean Vanetta. So I've been reading this. It's from Princeton University Press, and it's fabulous, and it's enlightening, and it's very, very interesting. And what you're going to find out is that American banking history is full of bank failures. Bank failures, state chartered, national chartered bank failures all over the place. You remember, all of you have seen It's a Wonderful Life? The bank fails because there's a run on money. They don't have enough money to lend out or to give back to the consumers, and the bank fails. That happens literally all the time. Literally all the time. 18th century, still happening. 19th century, happening. I mean, it's just literally all the time. We still, even just a couple of years ago, have the Silicon Bank Valley failure. We have these bank failures all the time. So I don't know why there's just this assumption that banks are inherently more safe. They're not. They're just as risky as any other financial institution. Banks are regulated a little bit differently than a mortgage lender. There are different organizations federally and statewide that are sort of providing oversight and regulation to these financial institutions. Now, banks, they have the OCC, they have the Fed, they have the FDIC, and they have a little bit different sort of regulation just because of the scope of their products. They don't do just mortgages. They have deposits. People are putting their money in there. When you go to a mortgage lender, they have nothing to do with your bank account. And so when somebody might say, hey, mortgage lender isn't FDIC insured, well, yeah, because they're not a depository institution. They don't have checking accounts. They're not liable for not having money to give you back. If you put $100,000 of your own money into this bank, the bank fails, they don't have the money to give back to you. They don't need that insurance because they don't have a bank account. All they're doing is lending capital to you. So if they fail, that's an asset for them. That's not a liability. So if you understand how the balance sheet works, that asset versus liability, if a bank has a sort of a bank account, that would be considered a liability for them because they're usually lending out that money. It's not an asset, it's not their money. And then you have the lenders, they don't have bank accounts. So they don't need FDIC to be FDIC insured because it's not a relevant product that they offer. So if they were to fail, there's no worry here. I mean, they don't have a bank account. What do you think they're going to do? Like, give up the mortgage to somebody or make you stop making payments? I mean, that would be great if they make you stop making payments. Sign up with the sketchiest lender I could find if they told me to stop making payments. But one thing you really have to understand also is that banks, credit unions, mortgage lenders, all of them alike, vast majority of them, as soon as they originate that loan for you, they're selling it on the secondary market to an investor, particularly GSEs, government-sponsored entities, Fannie Mae, Freddie Mac, purchasing these, and those are federally backed institutions that are going to guarantee the mortgage if in case of default or foreclosure for the investor, and most of them are going there. And so no matter who you go with, no matter what it says on the piece of paper that your mortgage statement comes back at as Bank ABC or Mortgage Lender 123, it doesn't matter. It's actually owned by these large investor groups. So no matter who you choose, that's where it's ultimately going. So the question of who's more trustworthy, well, they're both federally regulated. They're both have different sorts of product and offerings, but the mortgage lender is actually very specific. All they do is mortgage. They don't do anything else. So they're very streamlined on this. They're very efficient on this. They're experts, and all of their regulation relates to mortgages, to making sure that they are clear, truthful, honest, and making sure that they provide all the disclosures at the proper time. And that's why you're going to have a better experience with a mortgage lender or a mortgage broker than you are a bank. Banks are slower, they're not as efficient. Now, there are additional capital rules that banks will have if they decide to hold the mortgage on their own balance sheet, but that's a lot of banks aren't doing that because they want to free up the capital ultimately. So they're going to sell it on the secondary market. They may retain the servicing. A lot of lenders will still retain servicing. And so on your side, you think your loan is with your local bank, but it's not. They just have the servicing. They're just generating a little bit of revenue themselves by maintaining that element, but they've actually sold the investment off to somebody else. So a lot of people, for whatever reason, they're uneducated. They don't understand the differences. They don't understand sort of the regulations that go in, the state level regulations that mortgage lenders have, the significant amount of oversight that they provide, the audits that lenders are going through on a regular basis compared to banks. In my opinion, post Dodd-Frank, post housing crisis 2008, 2009, the mortgage industry is actually regulated more stringently than banks are. And banks are actually historically far more likely to fail and default than a mortgage lender is. So, from a purely risk standpoint, mortgage lenders, in my opinion, are far more of a better bet. Now, you as a consumer, someone choosing who to lend you money, it's a little bit of a silly sort of question. I mean, they're lending you money, you're not lending them money. So from a risk perspective, the only risk that you're onboarding really is just ease of use, or you're on the easiness of the online portal, because they're giving you money, you're not giving them money. So the questions you need to be asking are not really related to that. They're related to the professional that you're working with to originate the mortgage. Is that person trustworthy and knowledgeable? Does that person understand how to properly structure this loan to give me the most financially advantageous product? Is this person clear and consistent in their communication? Are they transparent in what they can provide and offer to you? Are they consistent in providing you great service? And if they are, that is a high trust environment that you need to work with. It shouldn't matter what name is on the mortgage statement. You're going to pay the same amount of money to a particular name, but it's ultimately going to go to one of these investors anyway. So when you're thinking, if you're worried ever about like, hey, are mortgage brokers or mortgage lenders less trustworthy? No, no, of course not. That's silly and outdated, and also historically ignorant of the facts. And so, yes, I'm a little bit biased. I'm a mortgage broker. I get it. So I want to say that mortgage brokers and mortgage lenders are very reputable and trustworthy, but that's because they are. Look at the list of top 10 lenders. Go Google some banks. Google Wells Fargo. What have they been up to with your money and your bank accounts? What have these other large banks been doing and not doing, or doing improperly? And you're going to find that, it's not this simple like, oh, mortgage lenders are just really untrustworthy. No, 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 no. It's particular people. Ultimately, it's nothing that has to do with banks that make them inherently untrustworthy, or mortgage lenders that make them inherently untrustworthy. No, no, no. What makes somebody untrustworthy is the sort of people that are involved with it. It's untrustworthy people that ultimately make these sort of decisions and will create an unhealthy sort of atmosphere. So my advice, go to a local mortgage broker, or go to a mortgage broker that you have a relationship with from somewhere else, but services in a small regional sort of way. And you're going to find a better experience, a more touch points, more communication, just a better overall experience, as well as your finances are going to be treated appropriately, and you're going to get the best possible deal that you can get. So I don't know if that answered all your questions, but I get that question enough to where I thought, let's create a video and have a resource to explain some of the differences between these two sort of institutions. There's no reason not to trust a mortgage lender over or less than a bank. They provide different services. They're regulated a little bit differently. One's regulated a little bit more stringently, in my opinion, than the other. But ultimately, if you're borrowing money that's not really the prime question that you should be asking. It's more about the individuals who are providing the service to you than it is the institution itself. Okay, let me know what you think. Drop a question or thought that you have in the comments. Always appreciate those, and like the video if you thought this was useful. And I look forward to thinking with you guys soon.